The next wave of tariffs is here, and it's putting entire sectors of the stock market in the crosshairs. This isn't some far-off economic forecast. Companies are already warning about the damage in their earnings calls, and it's only going to get worse. Most investors are holding on to popular, household name stocks that could see their profits squeezed. Their complex global supply chains, once a source of strength, have now become a critical vulnerability. This isn't a distant threat. It's an immediate danger to your portfolio that demands your attention. In this video, I'm going to reveal the 5 stocks that appear most vulnerable to this trade war. I'll break down exactly why their business models are on shaky ground and what you should consider to protect your wealth. This is not about panic. This is about strategic defense. The Tariff Time Bomb. For years, many investors have dismissed tariffs as political noise, but that phase is over. We are now in a reality where these taxes on trade directly impact corporate bottom lines. The mechanics are simple. Tariffs increase the costs for companies that import goods or raw materials. This directly attacks their profit margins, forcing them into a difficult choice. Either absorb the cost and watch their profits shrink, or pass the cost to consumers and watch their sales figures fall. But the danger is a two-way street. When the US imposes tariffs, other nations, particularly China and the European Union, often retaliate with their own. This creates a second front for American companies, hurting their ability to sell goods overseas and cutting off major revenue streams. We're seeing this play out right now, with sectors like manufacturing, retail, and agriculture caught between rising costs and retaliatory measures. In my years analyzing the market, I've seen investors make their biggest mistakes by ignoring these major shifts in global policy. They hold on, hoping things will go back to normal, while their capital is eroded. The key to survival and to profiting in any market is to identify these risks before everyone else does. So, which specific companies are standing on the train tracks? Let's get straight into the first and perhaps most exposed stock on our list. Stock number 1, the retail giant, Walmart WMT. The first stock you need to scrutinize is a name everyone knows, Walmart. For decades, Walmart's entire business model has been a masterclass in global supply chain efficiency, sourcing massive volumes of low-cost goods from China to stock its shelves. But that strength has now become its Achilles heel. A significant percentage of Walmart's merchandise is tied to China. With broad tariffs applied to consumer goods, Walmart's cost of goods sold is facing a direct and unavoidable hit. The company is now trapped. If they absorb the tariff cost to keep their everyday low prices promise, their already thin profit margins will be put under immense pressure. This is a fundamental threat to their profitability model. If, on the other hand, they pass these higher costs onto their customers, they risk damaging their core value proposition. Consumers, especially their target demographic, are highly price sensitive. A significant price hike on everything from electronics to apparel could lead to a drop in sales volume as shoppers look elsewhere. While Walmart has been actively working to diversify its sourcing to countries like India and Mexico, its sheer scale and reliance on China make it massively exposed. Either path leads to pain for shareholders. The market may not have fully priced in the long-term margin compression that Walmart is facing. This is a slow-moving but potentially significant situation for one of America's most popular stocks. Stock number 2, the footwear icon, Nike, NKE. The second stock on our urgent sell list is another global icon, Nike. The slogan might be, "Just do it," but the company is finding it can't just move its entire manufacturing footprint on a whim. Nike is profoundly exposed to tariffs because a significant portion of its products, especially its iconic sneakers, are produced in China and Vietnam. When the trade war first intensified, many companies began diversifying their supply chains into neighboring countries like Vietnam. However, this strategy offered limited protection, as tariffs were expanded to target goods from Vietnam as well. On July 2nd, the US implemented a 20% tariff on most goods from Vietnam. This has put Nike in a logistical bind. The company has spent decades optimizing its production in Asia, and shifting that complex network is a slow and expensive process. Now, bulls on the stock will argue that Nike has incredible brand equity, allowing it to raise prices. While that's true to an extent, there is a limit. When the price of a pair of running shoes could jump significantly, as some estimates suggest, even loyal customers might start to reconsider. You're not just paying for the swoosh, you're paying the tariff tax. This pressure is especially acute as about half of Nike's footwear is produced in Vietnam, a country now facing these new import taxes. The risk here is a fundamental disruption of the manufacturing model that has fueled Nike's growth for a generation. The stock is still trading at a premium, but the foundation it's built on is being weakened by trade policy. Stock number 3, the automotive behemoth, General Motors, GM. Our third stock, General Motors, is fighting a war on two fronts, and the company itself is sounding the alarm. The situation for U.S. automakers is a perfect storm of tariff-related pressures, and GM is right in the middle of it. First, there's the import side. Building a modern car is a global puzzle. Components come from all over the world, including steel, aluminum, and critical electronic parts that are now subject to heavy tariffs. This directly increases the cost of every single vehicle that rolls off GM's assembly lines in the U.S. Second, there's the export side. China is one of GM's largest and most important markets. Retaliatory tariffs imposed by Beijing on American-made cars make GM's vehicles more expensive for Chinese consumers, hurting sales and market share. This isn't just a theory. General Motors has explicitly told investors that tariffs are costing the company billions of dollars. In its second quarter 2025 earnings report, GM announced a staggering $1 billion hit directly attributable to tariffs. The company also stated that it expects the full-year impact to be between $4 and $5 billion. Worse, the company's management warned that the financial pain is expected to be even higher in the third quarter. When a company's leadership is telling you that a multi-billion-dollar headwind is getting stronger, investors need to listen. Stock number 4, the tech linchpin, Qualcomm QCOM. The fourth stock on this list is in a uniquely dangerous position. Qualcomm, the semiconductor giant, is at the absolute epicenter of the US-China tech rivalry. Its vulnerability goes beyond just tariffs and into the realm of existential market access. Qualcomm's exposure to China is staggering. The company derives roughly half of its total revenue from the Chinese market. Its chips are essential components for major Chinese smartphone manufacturers. This extreme concentration means any disruption to its business in China poses a massive threat to its entire financial structure. The danger is twofold. On one side, U.S. export controls aimed at kneecapping China's tech sector could restrict Qualcomm's ability to sell its most advanced chips to Chinese customers. On the other side, Qualcomm is a prime target for retaliation from Beijing. We saw a preview of this when the Chinese government banned chips from other U.S. firms from critical infrastructure projects. If Beijing decides to make an example out of a high-profile American tech company, Qualcomm, with its massive revenue exposure, is a logical target. This isn't just about paying a tax on goods. This is about the risk of losing access to a huge portion of your customer base overnight due to a geopolitical decision. That level of risk is simply not sustainable for a stock held in millions of portfolios. Stock number 5, the industrial powerhouse, Cummins CMI. The final stock we need to discuss represents the hidden dangers lurking within the industrial sector. Cummins, a leading manufacturer of engines for trucks and heavy machinery, is a company that is deeply and fundamentally entangled with the global trade system that is now under attack. Like the other companies on this list, Cummins faces a double-barreled threat. It relies heavily on a global supply chain for parts and materials, including from China, making it vulnerable to import tariffs that drive up production costs. But just as importantly, Cummins is heavily enmeshed in China, which serves as both a key manufacturing hub and a massive end market for its engines. Think about what happens when tariffs slow down global trade. Fewer goods are being shipped, which means less demand for new trucks. When global economic activity slows, construction projects can be delayed, meaning less demand for new industrial equipment. This systemic slowdown directly hits Cummins' order book. They are a bellwether for global industrial health, and right now, that bell is ringing an alarm. The company's deep integration with China makes it incredibly difficult to pivot. It cannot simply pack up its factories or abandon its customer base there. This deep entanglement, once a sign of its global dominance, now represents a profound and underappreciated risk in a world of escalating trade wars. So there you have it. Walmart, Nike, General Motors, Qualcomm, and Cummins. 5 household names, 5 stocks facing extreme pressure from a trade war that is showing no signs of stopping. The common thread here is a dangerous reliance on fragile supply chains and exposure to specific geopolitical adversaries. This isn't about panic selling, it's about being aware of the risks in your portfolio. If you're getting value from this breakdown and you want to stay ahead of these major market shifts, make sure you're subscribed with notifications turned on. The market doesn't wait, and neither should you. Your next step should be to audit your entire portfolio for this type of risk. Look beyond these 5 names. Which of your holdings are overly dependent on a single foreign country for manufacturing or sales? The companies best positioned to survive this new era are those with resilient, diversified supply chains or a strong domestic focus. Protecting your capital in this environment starts with one thing: identifying the biggest risks before the rest of the market wakes up to them. The tariff situation is real, it's happening now, and it is a powerful force that can put pressure on even the most established companies. By understanding these vulnerabilities, you are putting yourself in a position of power. Now that you know which stocks are most at risk, it's critical to know where to position your capital for safety and growth. That's why I've made another video, SLV Trap. In this video, I discuss trades like silver, where I have allocated some money recently. Link in description. Click the video on your screen right now to watch it. Don't wait.